This is a Treasury bond, a piece of paper, or more accurately, an electronic entry, that says the United States government promises to pay you back with interest. For 70 years, this has been considered the safest asset on earth, the risk-free rate, the foundation upon which every other financial asset is priced. But here's what's strange. If Treasury bonds are risk-free, why did the largest asset manager in human history just move $627 billion out of them? That's not a rounding error. That's not portfolio rebalancing. $627 billion is more than the entire GDP of Sweden. It's more than the market capitalization of every bank in Germany combined. When BlackRock moves that much capital in a single direction, they're not making an investment decision. They're making a statement about the future of the financial system. And the statement is this: something breaks in March. The filing was buried. Form 13FHR, submitted to the SEC on January 15, 2026, at 4:47 p.m. Eastern, 17 minutes before the filing deadline, ensuring minimal analyst attention before the weekend. The document runs 847 pages. I've read every one, and what it shows is the most significant repositioning of institutional capital since 2008. BlackRock reduced Treasury holdings across all maturities by $627 billion in the fourth quarter of 2025. They increased allocations to physical gold ETFs by $89 billion. They expanded positions in commodity-linked instruments by $134 billion. They initiated new positions in Bitcoin spot ETFs totaling $47 billion. This is not diversification. This is evacuation. Here's what they're not telling you. The March 2026 deadline isn't a secret. It's published on the Treasury Department's website, visible to anyone who knows where to look. But understanding what it means requires understanding the plumbing of government finance, the mechanical reality that keeps the entire system functioning. On March 14, 2026, the debt ceiling suspension expires. The current suspension, passed in June 2023, allowed the Treasury to borrow without limit for 33 months. During that window, the national debt grew from $31.4 trillion to $38.7 trillion, $7.3 trillion in new borrowing, with no congressional approval required for each increment. That window closes in 49 days. When the suspension expires, Treasury cannot issue new debt beyond the statutory ceiling. They can use extraordinary measures, accounting maneuvers that free up temporary borrowing capacity, but those measures buy weeks, not months. Based on current projections, extraordinary measures exhaust sometime between late April and mid-May. After that, the United States government cannot pay all its bills. Not because it chooses not to, because it legally cannot borrow the money to do so. This has happened before, in 2011, 2013, 2021, 2023. Each time, Congress eventually raised or suspended the ceiling, and the crisis passed. But each time, the resolution came closer to the deadline. And this time, the political configuration makes resolution nearly impossible. The House is controlled by a faction that has explicitly stated they will not raise the debt ceiling without spending cuts exceeding $2 trillion. The Senate is controlled by a party that has explicitly stated they will not accept cuts to Social Security, Medicare, or defense. The President has stated he will veto any bill that includes the cuts the House demands. These are not negotiating positions. These are structural incompatibilities. BlackRock's chief investment officer has access to political intelligence that retail investors don't. They know what's being discussed in back channels. They know which compromises are possible and which are theater. And they just moved $627 billion to the exits. The mechanism of Treasury market failure is poorly understood because it's never fully happened. But the mechanics are straightforward. Treasury bonds are the collateral that supports the entire financial system. When banks need short-term funding, they pledge treasuries. When hedge funds leverage their positions, they use treasuries as margin. When money market funds need safe assets, they buy treasuries. When foreign central banks need to park reserves, they hold treasuries. The total value of transactions collateralized by treasury securities exceeds $4 trillion per day. That's not a typo. $4 trillion of financial activity every single day depends on the assumption that treasury bonds are money good. A debt ceiling breach doesn't just mean the government can't pay bondholders. It means the collateral underpinning $4 trillion in daily transactions becomes questionable. And when collateral becomes questionable, counterparties demand more of it. When they demand more, prices fall. When prices fall, more collateral is needed. When more is needed than exists, the system seizes. This is what happened in September 2019, when overnight repo rates spiked to 10% over a relatively minor reserve imbalance. This is what happened in March 2020, when Treasury markets, supposedly the most liquid on Earth, experienced gaps and dislocations that required $4 trillion in Fed intervention to stabilize. A debt ceiling breach would make those episodes look like rounding errors. This is where the lie becomes unsustainable. The official position, from Treasury, from the Fed, from both parties, is that the debt ceiling will be resolved because it always has been. The consequences of failure are too severe to contemplate, therefore failure won't happen. But this logic contains its own destruction. If failure can't happen, there's no reason to compromise. If there's no reason to compromise, positions harden. If positions harden, failure becomes more likely. The certainty of resolution creates the conditions for its impossibility. BlackRock isn't betting on debt ceiling breach. They're betting on something more subtle, that the resolution, if it comes, will come in a form that damages Treasury values regardless. Scenario 1. Last-minute deal with significant spending cuts. This implies fiscal contraction, slower growth, lower corporate earnings, higher unemployment. Treasury yields might fall on safety seeking, but the economic damage propagates everywhere else. Scenario 2. Last-minute deal with no spending cuts. This implies continued deficit expansion, more Treasury issuance, more supply flooding into a market with declining demand. Yields rise to attract buyers, prices fall, existing holders take losses. Scenario 3. No deal. Extraordinary measures exhausted, prioritization of payments. Treasury pays bondholders but delays Social Security, Medicare, federal salaries. This preserves the technical sanctity of Treasury debt while demonstrating that the full faith and credit of the United States is now subject to political discretion. The risk-free asset becomes the politically contingent asset. Scenario 4. No deal, missed bond payment, technical default. Even if cured within days, the precedent is established. Treasury bonds can default. The risk-free rate is no longer risk-free. Every financial model on Earth requires recalibration. All 4 scenarios damage Treasury values. BlackRock isn't predicting which one occurs. They're positioning for the reality that all paths lead to the same destination. The $627 billion reallocation tells us exactly where the smart money is going. Physical gold, $89 billion increase. Gold has no counterparty risk. It cannot default because it makes no promises. It cannot be inflated because its supply grows at roughly 1.5% annually, regardless of policy decisions. When the asset that's supposed to be risk-free becomes risky, capital flows to the asset that's risk-free by nature. BlackRock's gold position is now their largest commodity allocation in history, larger than 2011, when gold hit $1,900 during the last debt ceiling crisis, larger than 2020, when pandemic uncertainty drove safe haven flows. They're not buying gold because they think it might go up. They're buying gold because they need assets that exist outside the Treasury-centric system. Commodity-linked instruments, $134 billion increase. Oil, copper, lithium, rare earths, the physical inputs that the global economy requires regardless of what happens in Washington. These assets have intrinsic value derived from utility, not from government promises. A barrel of oil heats homes and powers vehicles, whether or not Congress reaches a deal. A ton of copper wires buildings and manufactures electronics, whether or not the debt ceiling is raised. The shift to commodities signals something profound. BlackRock believes that claims on physical resources will outperform claims on government promises, that atoms will beat paper, that the real economy will diverge from the financial economy in ways that favor tangible assets. Bitcoin spot ETFs, $47 billion new position. This is perhaps the most striking allocation. BlackRock spent years dismissing Bitcoin as speculative, unbacked, unsuitable for institutional portfolios. Their CEO called it an index of money laundering in 2017. Now they're building a $47 billion position through the very ETFs they helped bring to market. Why? Because Bitcoin shares one critical property with gold. It exists outside the traditional financial system. Its supply cannot be expanded by congressional action. Its value cannot be diluted by Treasury issuance. Its settlement doesn't depend on the same infrastructure that Treasury bonds depend on. When the foundation becomes questionable, you need assets that don't rest on the foundation. The timing of March 2026 intersects with other pressures that amplify the risk. The Federal Reserve holds $4.2 trillion in Treasury securities on its balance sheet, the legacy of quantitative easing programs from 2020 to 2022. They've been reducing this balance through quantitative tightening, allowing roughly $60 billion per month to mature without reinvestment. But quantitative tightening requires someone else to buy the treasuries the Fed isn't buying. During the debt ceiling suspension, that buyer was the Treasury itself, issuing new debt to fund government operations. When the ceiling binds, Treasury issuance stops. When issuance stops, the supply-demand dynamics that supported QT disappear. The Fed faces a choice: continue QT into a market with no Treasury supply, causing liquidity to drain from the system in unpredictable ways, or pause QT, admitting that balance sheet normalization is impossible without Treasury cooperation. Either choice signals that monetary policy and fiscal policy are now inseparable. The Fed cannot operate independently when its balance sheet is dominated by the debt of a government that might not be able to issue more. Foreign holders add another dimension of pressure. Japan holds $1.1 trillion in treasuries, down from $1.3 trillion at peak. China holds $775 billion, down from $1.1 trillion at peak. Both nations have been steady sellers for 18 months. Their selling isn't political, it's mechanical. Japan needs to defend the yen against dollar strength, which requires selling dollar assets. China is diversifying into gold, commodities, and yuan-denominated instruments as part of their de-dollarization strategy. The largest foreign buyers are becoming sellers at the exact moment domestic political dysfunction threatens the asset they're selling. Supply rising, demand falling, March deadline approaching. The math doesn't work. Someone has to absorb the treasuries that foreigners are selling, that the Fed is not buying, and that domestic investors are increasingly skeptical of. That someone has historically been pension funds, insurance companies, and money market funds, institutions with mandates requiring safe assets. But safe is an assumption, not a fact, and assumptions can change overnight. When institutions like BlackRock move $627 billion, they're not just repositioning their own portfolios. They're signaling to every other institutional investor what the smart money believes. They're changing the narrative about what safe means. If BlackRock thinks treasuries are risky, why should a pension fund disagree? If BlackRock is buying gold, why should an insurance company stay in bonds? The repositioning becomes self-fulfilling as other institutions follow the leader. This is how market crises develop, not through sudden panic, but through gradual repositioning that accelerates as the deadline approaches. By the time the crisis becomes visible to retail investors, the institutional repositioning is complete. The smart money is already out. The losses are left for whoever remains. 49 days remain until the debt ceiling suspension expires. The extraordinary measures might extend that by another 60 to 90 days, so call it 100 to 140 days until the system faces a test it's never actually faced. BlackRock has already voted with $627 billion. They've decided that the risk of staying in treasuries exceeds the risk of moving to alternatives. They've decided that the March deadline, or its aftermath, will damage the asset class that has anchored global finance for 7 decades. They might be wrong. Congress might find a compromise. The ceiling might be raised cleanly, without drama, without damage. The Treasury market might continue functioning as it always has. But BlackRock doesn't move $627 billion on might. They move it on probability-weighted analysis with information advantages that retail investors cannot access. They move it when their models show that the expected value of staying exceeds the expected value of leaving. Their models just said leave. The divergence between what institutions are doing and what they're saying has never been wider. Publicly, every major financial institution affirms confidence in treasury markets, in congressional resolution, in the full faith and credit of the United States. Privately, they're moving to gold, commodities, and Bitcoin at the fastest pace ever recorded. The words say everything is fine. The flows say something else entirely. This is not a prediction about what will happen in March. It's an observation about what's happening now. The largest pools of capital on Earth are repositioning away from the asset that's supposed to be the safest on Earth. They're doing it quietly, through regulatory filings that few people read, in allocation shifts that don't make headlines. By the time the headlines arrive, the repositioning will be complete. Physical gold cannot be defaulted on because it makes no promises. Commodities cannot be inflated because their supply is constrained by geology and physics. Bitcoin cannot be debased because its code enforces scarcity that no Congress can override. These assets share one property. They exist independent of the system that BlackRock is quietly exiting. The $627 billion is not a trade, it's a verdict. The largest asset manager in history has examined the treasury market, the debt ceiling dynamics, the political configuration, and the timeline, and concluded that the risk-free asset is no longer risk-free. March 2026 will arrive whether or not Congress acts. The deadline doesn't care about negotiations, doesn't respond to political theater, doesn't extend itself for convenience. What happens when the deadline meets the dysfunction is unknown. What's known is that BlackRock decided not to wait around to find out. Reality doesn't wait for consensus. It doesn't pause for legislative process. It simply arrives on the calendar date specified and rearranges everything built on assumptions that turned out to be wrong. The assumption that Treasuries are risk-free has undergirded global finance for 70 years. That assumption is being tested in 49 days. $627 billion says it won't survive the test.